Preparing for the impending recession, essential steps you must take. The past couple of years have been quite a roller coaster for everyone on Earth. First, we had a global pandemic that led to a 3-month economic downturn as industries worldwide came to a standstill. People were stuck in quarantine, and the death toll from COVID kept rising. Then, in September 2020, there was a bit of good news when Keeping Up with the Kardashians was announced to be finally cancelled. Just when it seemed like things might be getting better as the COVID situation improved, Russia decided to complicate matters by invading Ukraine, causing global markets to go haywire once again. And if that wasn't enough, 3 weeks after the invasion, the Kardashian family made a comeback with a new reality series on Hulu. Unfortunately, the troubles didn't end there as the world started facing the consequences of the seeds sown during the COVID pandemic, leading to inflation. Inflation globally is currently at its highest point in almost 50 years, and in the United States, it's reached 8.58%, a level not seen since 1981. This significant increase is mainly because the costs of food and energy have gone up, largely due to the slowdown in these industries during the COVID pandemic. Between February and March of this year, food prices shot up to 12.6%, marking the highest inflation rate since 1990. The war in Ukraine has hit wheat and other grains particularly hard, causing a 17.9% increase in costs. This is due to the direct impact of the war and the Russian embargo on Ukrainian shipping. Given that both Russia and Ukraine are major producers of the world's wheat and grains, the conflict has had severe effects on commodity prices. Russian troops have damaged or mined Ukrainian fields, and whatever wheat has been harvested either gets stolen by Russian forces or is blocked by Russian ships in the Black Sea. The situation is becoming dire, especially for poorer African nations facing the threat of famine. To address this, there's a growing call in the West for NATO warships to escort Ukrainian trade convoys aiming to break through Russian blockades. The Russians are confronted with a critical choice that carries significant consequences. Either confront the superior NATO fleets, escalating the war dramatically, or allow Ukrainian grain to be shipped abroad, thereby alleviating the threat to African nations and reducing global food prices. The world's heightened demand for goods has also played a role in the current historic inflation. As billions of people emerged from lockdowns and quarantines in late 2021, they flooded stores worldwide with the money they had saved during the quarantine period. The collective hunger for life led to a surge in demand, causing prices to rise. Additionally, energy prices have surged in recent months due to Russia's invasion of Ukraine. A perfect storm of these factors has unfolded at the worst possible time, when people were eager to resume their lives before the pandemic. Sanctions against Russia and disruptions in Russian oil supplies have triggered a sharp increase in oil prices. Compounding the issue is the refusal of the OPEC nations to boost production to counter Russia's disruption. For OPEC nations like Saudi Arabia, the continually rising oil prices are proving to be an economic windfall, allowing them to make substantial profits while the rest of the world suffers. Fortunately, and likely due to reminders to nations like Saudi Arabia about who truly ensures their national defense against threats like Iran, President Joe Biden successfully negotiated an increase in oil production by OPEC. This move is expected to bring down oil prices in the upcoming summer months. Now, how do you navigate the approaching recession? Firstly, take a deep breath. Recessions are temporary, and even the Great Depression eventually gave way to an economic upturn, leading to the most prosperous era in US history. While World War II played a role, the end of the Depression was inevitable, just like the eventual end to this recession. Considering the average duration of a recession is around 11 months, maintaining perspective and not succumbing to what investors term as FUD, fear, uncertainty, and doubt, is crucial. Governments worldwide are increasing interest rates to combat rising inflation. This translates to higher interest rates on loans for significant purchases like houses and cars, meaning you'll end up paying more. This strategy is a primary tool for central banks to fight inflation, as higher interest rates discourage consumer spending, which, in turn, reduces demand for goods and helps bring prices back down. For the time being, it's advisable to hold off on buying a car or a new house. Instead, focus on saving and patiently waiting for the end of the recession when, historically, there's a surge in economic growth and interest rates tend to decrease again. If you're an investor, it's likely a period of significant anxiety. Traditional stocks, as reflected in the S&P 500, have experienced a substantial decline, officially marking a bear market with a 20% drop from the recent high. This decline has erased billions in value across the entire stock market, leading to crashes in some portfolios. For cryptocurrency investors, the situation is equally challenging. The crypto market has lost over $1 trillion in value since March 2022. There seems to be no clear bottom in sight, with even Bitcoin, the largest cryptocurrency, losing over $60 billion in market capitalization in recent months. The collapse of certain altcoins, notably Luna, has instilled fear in the crypto market, deterring new investors and exacerbating the situation. Bear markets might not be inherently bad for investors if they can endure the downturn for the long haul. It's crucial to remember that losses aren't realized until you sell, and unless you have a solid reason to believe your investment is plummeting, resisting the temptation to sell and cut losses may be wise. Instead, consider refocusing priorities and reallocating investments into different assets. Consumer goods, healthcare, and energy are generally reliable investments during bear markets as they are essential to everyday life and tend to experience lesser losses. In fact, you might even see a small return amidst a bear market, especially in industries providing critical consumer goods. For crypto investors, it's time to re-evaluate and potentially shift away from riskier assets to more established ones. Major coins like Bitcoin, Ethereum, and Solana are less likely to face significant downturns due to their widespread adoption. People use these coins, and although still risky, there's inherently less risk in well-established cryptocurrencies compared to newer, less proven ones. Determining which coins are likely to weather the crypto crash can be done by examining total market capitalization, providing insights into coins that people are actively using or holding. Whether you're into traditional investments like stocks or riskier options like crypto, the key during a bear market is to avoid attempting to time the market. Instead of trying to pinpoint the lowest point, it's better to invest like a responsible adult, employing the tried and true strategy of dollar cost averaging. Dollar cost averaging involves investing a fixed amount regardless of the current price at scheduled intervals. For instance, if you receive income on the 1st and 15th of each month, you invest on those dates irrespective of the price at that time. In the long run, the strategy tends to be more successful than trying to accumulate capital and timing the market for optimal entry points. It's a shift away from chasing quick gains in flashy assets to a more stable and disciplined approach. Another essential step to weathering a recession is to prioritize paying off your credit card debts as quickly as possible. While this might be challenging, it's crucial because interest rates are on the rise. This means that your debts will continue to grow each month, making it increasingly important to reduce it promptly. If you're only making small payments for a long time, a slight increase in interest rates could mean paying a lot more. So it's a good idea to cut back on spending and focus on paying off your credit card debts quickly. Also, start saving money because during a recession, it can affect many industries and you don't want to end up without a job and no savings. Tighten your budget, reduce expenses, and make sure you have some savings for unexpected situations. If you have a good amount of money saved up, consider looking for assets that can protect your wealth without losing value. Traditionally, gold and real estate are seen as safe during inflation and recessions, but be cautious about hoarding property due to concerns about a housing bubble. With home prices rising globally, there might be a risk of a drop in real estate value, especially if there's social unrest and demands for government action. It's essential to be aware of the situation and maybe consider investing your money elsewhere. Also, keep in mind that buying real estate just to store your money might contribute to the problem by reducing supply and increase prices for everyone. During a recession, stocks may face challenges, but bonds are generally considered reliable investments even in tough economic times. Although bond prices have been affected by the recession, diversifying your investments can help manage the impact of an economic downturn. Wondering about the difference between stocks and bonds? Well, stocks mean you own a piece of a company, like if you buy Apple stocks, you're a partial owner of Apple. On the other hand, bonds are like loans you give to a company or government. When you buy a bond, they owe you that amount and you get interest on that loan for a fixed time. Let's say you get a 10-year bond for $2,500 with a 2% interest rate. Each year, you'd get $50, and at the end of the 10 years, you'd get your $2,500 back, making a $500 profit. Now, both stocks and bonds have their own risk and reward. Stocks can bring in better returns, especially when the company's value goes up. It's a bit like a gamble, but if things go well, you could see some nice profits. But it works the other way too. If the company's value goes down, your stock value does too. Now, bonds are like the safer option. You might not make as much, but it's a pretty reliable return. The main risk with bonds is if the place you got it from goes belly up, like a company or government collapsing. When times are tough, like during a recession, switching from stocks to bonds can be a good move. Bonds may not bring in big returns, but they're steady and can help you get through the economic rough patch. No matter what your game plan is, the key is to not freak out. Recessions don't last forever. The sun will come out again. Well, unless you put your money in Luna, that might be a different story.